Hey, personal finance. This is Mrs. Lamphere, and we're looking at Unit 4, Banking and Insurance. So this first video is going to be, excuse me, just over banking. And in the next video, we'll go into the insurance portion. Let's start with banking, and with a little review of what we should already know by now. So by now, you should know that it's better to have money and not be in deficit. We want to avoid bad debt at all costs. So this is things that we buy. We don't want to buy things that are going to be consumed quickly, and then we get stuck paying for them for a long period of time. That would be some bad debt. And then save part or all of incoming money. So even at this stage of your life where you're maybe just getting like birthday checks and random income, make sure you're saving 10, 20, 30, 50% of it so that you have some money set aside and you're not spending everything. All right, so when you do have that money on hand, where are you going to store it? If it's right in maybe your socks drawer, that might be a little too accessible for you, and you might kind of might leave that burn a hole in your pocket type thing. So you might want to be sticking that money into a bank account. So we're going to talk today about banks, credit unions, and other financial institutions. We're also going to go into savings accounts, checking accounts, and talk about how those different types of accounts work and their uses. So first of all, let's start with the savings account. And I think when I did a show of hands earlier, it seemed like that most of you already had a savings account in place, which is awesome. So this might be kind of a repeat of information for you. So a savings account is a bank account that pays interest on the money in the account. With a savings account, you can withdraw or take out money. You can deposit or put in money. You cannot write checks. So you can either withdraw or deposit money from your savings account. Usually you either have to go to the bank to do that, or maybe if you have an ATM card, you can do that at ATMs. So for example, you deposit $100 into a savings account that pays 10% annual, which means yearly interest. So after a year, if that's all the money you put in there, and it earned you 10% interest, at the end of the year, you would have $110 available in your account. So the more money you have in there, the more interest you will earn on that money sitting in your account. So that's why it's another reason, instead of just having that money sit at home and it's not really gaining any value, you can put that money in an account that will grow from interest. Okay, here's the catch. And it's not really a catch, but I don't really like how your text sets up savings account. Because with a savings account, you will never find an account that offers 10% annual interest. That's a lot for a savings account. Most savings accounts offer less than 1% annual interest. So keep that in mind, that you won't be in a savings account, your money really won't grow that much. It's better than nothing. It's better, again, than just sitting at home doing nothing. But when you're talking about 10%, 12%, 15% interest, that's more looking at mutual funds, which we're going to talk about in the investment unit. So just keep that in mind. Savings accounts don't usually earn you that much interest. But again, it's better than just sitting at home. So then there are a couple different types of savings accounts. We have a statement savings account, and this is the most common. I'm really not sure why they divide it into two different accounts, but because most people do use this statement savings. So with a statement savings, your bank will mail you a statement each month, or maybe if you signed up for online email notifications, they will do that too. And it will just show, so your bank statement shows the deposits, the withdrawals you've made, the interest that you've earned on your money. So at the end of each month, they'll send you a statement that shows all of that information. And most savings accounts do have some type of minimum balance requirement. Then we have what's called a passbook savings account. These are, again, they're rarely used. I'm not really sure why your text even talks about them, but we'll mention them here as well. With a passbook savings account, the account holder logs all transactions in a book or a log. So it's kind of like you're the one in charge of charting all of the withdrawals and deposits and transactions and all that stuff. And with this account too, there's also a minimum balance that's required and you can also get charged a fee if you lose your like book of logging that you do with your transactions. There could be a fee if you lose that. So I would, I don't know, I wouldn't really concern yourself with passbook savings. Maybe just stay focused with the statement savings account because, again, that's the most common. All right, checking accounts. So a checking account then stores your money until you want access to it. You can access that money by either a check. You can also use an ATM card or a debit card to access the money in your checking account. Checking accounts typically don't earn interest, and they could also require a minimum balance. So I think I know to open different accounts you had to have $5 in there, but a lot of times checking accounts require maybe that you have $100 or $500 or $1,000. When you pay by check debit card, it's a great alternative to carrying around cash. We've mentioned that before. It's kind of just easier. It's faster. It's more convenient. But always keep in mind what Dave Ramsey told us about if we're using anything but cash, that's when we get stuck paying 12 to 18% more just because it's easier. So keep that in mind, that you might be spending more than you would normally if you were just using cash. Here, keep in mind it's easier to spend. So that was my point there with the 12 to 18%. But also by using a check or a debit card, it's good proof of payment. So usually if you pay with cash, you get a receipt, which is your proof of payment, but everyone throws their receipts away. So if someone contacts you later and says, hey, you never paid us for this, unless you have the receipt, you might not have proof. But if you have like a check or if you used your debit card, that will all show up on your checking account, and that's kind of your payment history or your proof of payment. Let's talk about bouncing a check. When you bounce a check, this is when you write a check for more than what you have available in your account. So if you have $100 in your checking account and you wrote someone a check for $150, then you're bouncing that check. When that person goes to cash that check, the bank's going to be like, whoa, that person doesn't have the money to back this check up. So then that person won't get paid. And when people don't get paid, you get charged with additional fees and your credit rating will suffer. So you've probably, and a lot of places don't even accept checks these days, but you might have seen signs that say like $35 charge for bounced checks or return checks, meaning the bank didn't cash it because you didn't have those funds available. So then you end up paying that the store, whoever you wrote a check to, $35 more because of that bounced check. Okay, more about checking accounts. There are some checking accounts that are interest-bearing accounts. Earn interest usually requires a minimum balance. Then there's also non-interest-bearing accounts, which do not earn interest and usually do not require a minimum balance. So again, you can find a free checking account at a lot of banks offer free checking, but usually with free checking, you don't have the interest that comes with it. You could also have joint checking accounts, and some of you might have this with like your parents, or your parents might have one with each other. Joint checking is an account that's owned by 2 or more people who have equal access. So when I was under 18, I actually had a joint checking with my mom, and she had access to deposit money or to also write checks out of that account, and so did I. And now that I'm married, my husband and I have a joint checking account so that we both just have equal access to that account. And there's also student checking accounts out there. These are checking accounts that are geared more towards students, usually because they're free, they don't require minimum balance, usually maybe not as many fees because you are a student. So that might be something worth looking into once you guys go on into college. And then, click on here. All right. Then we also have what are called express checking accounts. These are a checking account that is designed for people who would rather do their banking electronically. So it would just be like, an electronic checking account. So you can access it to maybe pay bills online and set it up that way. And again, I think this information's a little outdated because we can do all of that stuff with my husband and I's checking account that we have now. We're able to do a lot of our online online banking. Okay, so then aside from savings accounts and checking accounts, we also have what are called money market accounts. And you maybe remember Dave mentioned money market accounts last week in our Class Connect when we were talking about emergency funds. So a money market account is a kind of a mix between a savings and a checking account. So it's an account where you'll store your money and you get higher interest rate than a regular savings account. But then you also have limited access to your money. So generally with the money market account, you're limited to 6 or less transfers or withdrawals and no more than 3 checks written each month. So so again, it's money. It's an account at the bank. It earns higher interest than savings, and you can access it like checkings, but just with limited amount of access. And that's kind of why you get the higher interest rate. And so that's why Dave said that this would be great for an emergency fund. So that 3 to 6 months of expenses that we should be putting away. He suggests money market accounts because it's emergency money only, so you shouldn't be accessing it all the time anyways. It earns a little bit higher interest, so because it will just be sitting there a lot of the time, you can get some higher interest earned off of it. And you still have access to it with those maybe 3 checks a month. So if a storm tears off the house roof, or if someone gets in a medical situation, breaks their arm, that you would have access to that money to pay for those things. And so another good reason is, since it is limited access, you won't be tempted to touch it. So unless it's emergency, you won't be as tempted to go in there and get that money, just because you can get fined or you can get hit with a fee if you go over those limited transactions. And like we said, it does earn higher interest than a typical savings account. And we also have what are called CDs, or Certificate of Deposit. This is another type of account. So with a CD, you are agreeing to keep a chunk of money in an account for a specific period of time. So this period of time is either 3 months to several years, and you're basically putting that chunk of money in there, saying you won't touch it for however long, 3 months, 6 months, 1 year, 5 years, however long. And then you're going to lock in at a certain interest rate for that period of time. So typically, this is the highest type of interest rate, interest-bearing account, because it's money that you're promising that you won't touch for a certain chunk of time. So again, you will not have access to this account for that period of time that you signed up for. But if you do end up needing that money for whatever reason, you will be hit with a pretty hefty penalty. So if you put some money in a CD, make sure it's money that you don't need for that 3 months to 5 years, just so you don't get hit with that penalty. All right. And then with any banking account, you want to make sure that it is insured by the FDIC, the Federal Deposit Insurance Corporation. So what FDIC does, it protects, and this information changes every year, but the most recent that I found was the FDIC generally protects the first $250,000 of deposits. So they'll protect, so maybe if you have $300,000 in that bank, and the bank, for whatever reason, goes under, maybe they get robbed, you will get at least $250,000 of that money back if you had $300,000 deposited in the bank. And so most people don't have that much deposited in a bank. Usually they're putting their money elsewhere, like in investments and different things. So that's a pretty good protection policy if you get that much coverage. And then there's a really good video on page 10 of your text in this unit, so make sure you watch that, and it explains the FDIC in a little better context there. All right, so then we have a couple different types of banks or financial institutions. First, we're going to talk about commercial banks. These are the ones we're probably most familiar with. With banks, this would be like